Hi, welcome to Jared Invests. Today we are going to be discussing about the 10 things every college student needs to know before they sign their name on a student loan. 40% of people who take out student loans never graduate. They drop out, change plans, or life just happens, and they still owe every single dollar. No degree, no higher salary, just the bill. That number should stop you cold. Because the loan doesn't care whether you walked across that stage or not. The loan only cares about one thing: getting paid back. By the end of this video, you will know exactly what you signed or what you're about to sign and what it actually means for your financial life over the next decade and beyond. 10 things. Concrete numbers attached to every single one. If you've already signed, some of this will hurt, but knowing it now is still better than finding out the hard way at 28 when your credit takes a hit and you can't figure out why. Here's the uncomfortable truth: nobody in your financial aid office is going to say out loud. The loan itself is not the crisis. What you don't know about it is, student debt has a marketing problem. It gets talked about like it's just a number on a screen. $30,000, $50,000, whatever your total comes out to. People treat it like a car payment they'll deal with later. But a car payment doesn't compound while you sleep. A car payment doesn't capitalize. A car payment doesn't come with a 20-year legal contract that most people sign in under 3 minutes without reading a single word. That's not an exaggeration. The average 20-year-old spends less time reading their master promissory note than they spend choosing what to eat for lunch. 3 minutes, a document that will shape their financial decisions for the next decade, skimmed like a terms of service agreement on a free app. So let's talk about what's actually in that document and what comes after it. Right now, 25% of borrowers fall delinquent within 3 years of entering repayment. 1 in 4. And a GAO report from March 2026 found that federal student loan servicers, the companies responsible for managing your loans and keeping you informed, missed 1 in 4 required customer contact attempts. The system meant to help you navigate repayment can't even reach you a quarter of the time. When things go wrong, the consequences land on your credit report, not theirs. Here's another one. The average student loan balance is $37,338. At 6.5% interest over a standard 10-year repayment plan, that's $421 every single month. Not a small number. That's a car payment. That's 3 months of groceries. That's the difference between building an emergency fund in your 20s or living paycheck to paycheck while technically making decent money. And still, millions of students sign on the dotted line without knowing what's coming, because nobody sat them down and walked through it. That ends here. The number one mistake people make with student loans is deciding they'll figure it out after graduation. I'll deal with it when I have a real job. Sounds reasonable. Completely wrong. Here's why that logic breaks. Your 6-month grace period after graduation moves fast. Most borrowers don't even realize repayment starts automatically. No reminder, no warning, no second chance. You don't have to opt in. You just start owing. If you haven't set up your repayment plan, picked your servicer contact, or even logged into your loan account before that clock runs out, you are already behind. And being behind isn't just stressful, it starts costing money on day one. The time to understand your loan is before you sign it. The second best time is right now. Number 1. The master promissory note is not a formality. When you sign the MPN, you are entering a binding legal contract. It governs every federal loan you take out, sometimes for your entire undergraduate career, under one signature. Not a registration form, not a financial aid checklist. A legal obligation, and courts have upheld it every time a borrower tried to claim they didn't understand what they signed. Read it. All of it. Know what you are agreeing to before your pen or your mouse click makes it real. Number 2. Interest starts accruing on unsubsidized loans from day one. Most students never think about this split. Subsidized loans, the government covers your interest while you're in school. Unsubsidized loans work differently. Interest starts building the moment the money lands in your account, not the moment you graduate. 4 years of school on a $30,000 unsubsidized loan at 6.5% means that loan becomes $38,100 before you've made a single payment. You borrowed $30,000. You owe $38,100. $8,000 added while you were just trying to get a degree. That's the compounding reality nobody puts on the brochure. Number 3. Capitalization is the silent multiplier. When unpaid interest gets folded into your principal balance, that's capitalization. Once it capitalizes, you're paying interest on the interest. That $8,100 that built up during school, now it's part of your loan balance. Now it earns interest too. Over 10 years, the actual total cost of that original $30,000 loan runs far higher than most borrowers ever calculate. Capitalization hits at key moments: when you leave school, when a deferment ends, when you miss certain deadlines. Know those trigger points. Number 4. The SAVE plan is gone. Plan accordingly. In July 2025, the SAVE repayment plan was eliminated. 4 million borrowers lost income-driven repayment protection overnight. Just gone. No gradual phase-out, no long transition period. One of the most widely used federal repayment options, wiped. If your financial plan relied on SAVE keeping your payments low, you were suddenly forced to scramble. The lesson isn't just about SAVE specifically, it's that federal repayment programs are not permanent. They are policy decisions. They change with administrations. Anchoring your entire post-graduation budget to a specific program still existing when you need it is a real and documented risk. Number 5. Income-driven repayment forgiveness comes with a tax bill. IDR plans let you cap your monthly payment to a percentage of your income, and after 20 or 25 years, whatever balance remains gets forgiven. Sounds like the end of the story. It's not. That forgiven balance gets treated as taxable income unless Congress has explicitly renewed the tax exemption. If $60,000 gets forgiven in year 25, the IRS may count that as $60,000 of income in that tax year. Your tax bill for 1 year could hit 5 figures. Most borrowers running IDR calculations never factor that in. You have to. Number 6. Your loan servicer might not actually reach you. That GAO report from March 2026 is worth repeating. Federal student loan servicers missed 1 in 4 required customer contact attempts. These are the companies handling your account, processing your payments, and flagging changes to your loan status. Missing critical communications, rate changes, repayment shifts, forgiveness deadlines, can trigger delinquency or wipe out program eligibility. None of those consequences fall on the servicer. They fall on you. Set your own calendar alerts. Check your loan dashboard directly. Don't count on a phone call or email to protect you. Number 7. Private loans are a completely different animal. If you exhaust federal aid and start looking at private loans, you need to know what you're walking into. Private loans carry no income-driven repayment options. 0. No forgiveness programs. No deferment flexibility anywhere close to federal. And variable interest rates that can climb past 14%. No safety net. If your income drops, if you lose your job, if a medical crisis hits, a private lender's standard answer is still pay your bill. Private loans aren't always the wrong move. Sometimes they're necessary, but you are taking on fundamentally higher risk with far less protection, and the terms of that risk are written by a bank with no obligation to make your life easier. Number 8. FAFSA errors cost real money. Missing one detail on your FAFSA, a typo in your Social Security number, a missed tax form, a late submission, can cost you thousands in grant money you were eligible for. Not loan money. Grant money. Money you never pay back. The Pell Grant, institutional aid, state grants, all of it flows through your FAFSA. Students who blow past the priority filing deadline at their school often receive significantly less aid, or none at all. Free money with a hard deadline attached. Treat it that way. Number 9. The grace period ends whether you're ready or not. 6 months after you graduate, leave school, or drop below half-time enrollment, repayment starts. Automatically. No opt-in required. No countdown shows up in your email. Your servicer may or may not successfully reach you before it happens. The borrowers who get blindsided are the ones who assume someone would make sure they were ready. Set the date in your phone the day you leave school. Know exactly when that clock runs out. Have a repayment plan selected before it does. Number 10. 40% of borrowers who took on debt never graduated, and they still owe the full amount. Say that out loud. 4 in 10. No degree. Full balance. Not a fringe outcome. One of the most common scenarios in the entire student loan system, and it almost never comes up in the conversation about whether to borrow. If there's any real, honest chance you might not finish the degree you're borrowing for, that has to enter the equation before you sign. Dropping out doesn't clear the debt. Changing your major doesn't clear the debt. Only very specific legal circumstances discharge federal student loan debt, and I didn't finish is not one of them. Here's the math moment that pulls all of this together. A 22-year-old who graduates with $37,338 in student loans and doesn't understand what they signed is likely to pay far more than they planned. They capitalize interest during deferment. They miss a FAFSA deadline and leave grant money sitting on the table. They pick the wrong repayment plan. They never account for the IDR tax hit at year 25. They take one private loan without reading the full terms. Conservative estimate that borrower pays somewhere between $15,000 and $25,000 more over the life of their loans than someone carrying the exact same debt who understood the system from the start. Not because they earned less, not because they were less responsible, just because nobody walked them through it. That gap, $15,000 to $25,000, is the cost of not knowing. 3 steps, right now, today. First, log into studentaid.gov and pull up every federal loan you currently carry: balance, interest rate, loan type, servicer name. Write it down. Know the exact numbers. Second, if you're still in school, check whether your loans are subsidized or unsubsidized and calculate what the interest will be by graduation. That number should shape how much you borrow going forward. Third, if you're approaching graduation, run the repayment estimator on studentaid.gov before your grace period ends. Pick a plan. Set a calendar reminder for the exact date repayment starts. Don't let it catch you off guard. Now here's the question I want you to answer in the comments. Which one of these 10 things did nobody ever tell you? Because at least one of them is new information. Drop it below. Your answer genuinely helps me know what to cover next. The loan is signed, the clock is running, but knowing the rules is still your best move. Subscribe to the channel if you enjoyed the video.